Yo, yo, yo. Can we hear? Everybody know what's going on? Can we hear everything? Yo. What's up, Chosen? Max? What's going on? Let's see if I can get this. Maybe I won't be able to. Let me tweet out the stream real quick. There we are. Oh, all right, go ahead and start asking your questions. Fundamental analysis, looking at long-term plays. Also, we'll be looking at any macroeconomic questions anybody has. I just want to give some people some content. Good evening, Bulldog. Got my coffee. I don't know if y'all saw my tweet, but I got some coffee. So, first off, we can kind of just go over the day. So my day consisted of actually watching a lot of this BBIG, watching it kind of consolidate in this range right here. Just pull up a simple quick chart here. Textbook bull flag. We'll see how it continues into tomorrow. I'm not sure how it ended the day. Let's see. Oh, that's not gonna work. Let's see, where's it at? Yeah, so I mean it's up after hours, a little bit back to 750. So it's sort of just consolidating here in this. Let me turn on extended hours. So look, even in the extended hour, it's still following the same pattern. Hello and good evening. Hello, Parvin. So this was interesting to watch. GSAT actually had some news after hours. This huge candle here was in reference to iPhones not having the ability to use geolocation services. But then this huge candle here, this I think it was a 10% candle up and a 14% candle down, was in reference to essentially the, it's a good way to put it, the geolocation services Apple said in emergencies only. Yeah, so fib extensions. All right, good example here. Let me turn off the extended hours here. So for example here, let's just pick on AMC. I'm going to turn off VWAP because it's going to get annoying while we're looking at it. I like to do these for like swing trades and such. I'll use, say, the 1 hour. So a way to use Fibonacci's extensions and retraces. So an extension in your toolbar and trading view, I have mine highlighted and noted. So for any time, you're always going to look from the bottom of the trend and draw to the top first. So in Elliott wave theory that Avery teaches, you'll notice that it goes from the bottom of the wave to the first wave. So if we were to name these waves, and this is just solely based on this real quick, this is not based on anything real, but say this was wave 1, this is 2, say this is wave 3, this is wave 4, AMC might go for wave 5, whatever it is. Well, you're going to measure from 0 to 1. So I'm going to pull out my Fibonacci retracement. Which is just called a retracement. You're going to go from the lowest point to where wave 1 ends, roughly around in that area. I had to change mine because I have a setting for retracing extensions, and it automatically will do that. And so you notice I retrace it and do an extension all the way to the top of this first major wave before we have a correction here. And you'll notice how it just automatically plots it out. Now these are the settings, and I don't know if you want to take a screen share of this. I have mine set. On 0, 1.618, 1, 1.414, 2.618, and 2. Those are just the generic ones that I use. And you can tell, right, it hit the 2, so 1, 2, We pull a fib extension from the bottom of the wave here, or from the bottom of the trend, essentially, waiting for it to bottom out. It double bounced here, double bottom. Grab it from here, drag it to the top here, roughly around where these candles start to wick out. And you can use you can go all the way to the top of the wick. Some people like to go where the candles form. I choose in the middle, where you have roughly a lot of candles touching. So I have 1, 2, 3, 4, 5 candles touching that one line. So I think it's going to work fine for me. And you can tell as AMC, it considered this area as some resistance, but it continued to push up higher. And as it pushed up higher, it met this 200% fib extension with some resistance there, which does correlate back to previous areas of resistance too. So if I were to pull up, say, like the 1-day chart, I basically just did a fib extension from the bottom of a double bounce or double bottom to the top of that first wave of a new wave, and you can tell it's broken out of this wave as we've seen in this crazy massive move up, and then it's going to retrace here. Now you can start to use these things with multiple different other patterns and ways to kind of do technical analysis. So another way is just to correlate it with what else is going on. So I'm going to go down to the 15 minute to make this a little bit easier on myself. Grab this, just start the chart out. Okay, I see a higher low here, right? We bounced up, we retraced about 50%, maybe even to the 618, which another example is grab your fib retracement, bottom to the top again. It's going to get a little messy. Change this to a retrace just to double check yourself and see how far down AMC retraced. So from roughly right around here, let me grab it right to where I like it. Roughly the top of that candle there. So it basically briefly breached the 618 retrace and then continued upwards. That's just another way to check on yourself there. But now it's going into this pennant, and you'll see it probably just continue consolidating. I'm going to go to the 30 minute. It'll probably sit here and do this motion right here until it breaks out either upwards or downwards. And so when this type of play comes around, what you're going to want to be careful of is that you're not in the wrong position. So I personally, I don't like to trade pennants like this because they're relatively basically unreliable in my opinion. Some can be bearish, some can be bullish. It just depends on the time frame you're looking at. So currently it's probably just going to sit here and for the next couple of days until probably tomorrow it's going to make a choice, maybe either tomorrow or the following day. It's going to make a choice on what it wants to do. If you see a massive break up and it gets over this area right here, which is roughly $47, you can continue to see it go up. If it breaks down, it's probably going to come and retrace to this $38, $39 area. Yeah, so DCF method, for those that don't know, in that comment that William just posted, is the discounted cash flow method. I built a calculator, but I have some difficulty to find a good growth rate where we can find those type of infos. So you're really going to find different growth rates from different companies. So I'm going to pull back up the, let me see if I can open it back up. Just go to Yahoo Finance, basically. My doesn't want to work for me. Oh, I know why. So I'm going to pull up Yahoo Finance, and or even investing.com. So like, it depends on the type of company you're looking, right? So growth rates, DCF. So this is just a simple Google you can do. You can go from, I mean, there's been rates from 5% to 15%. It really is in the business. If you're in like a tech business, you're going to have a higher DCF growth rate than you would for, say, a utility business. There's no real true percentage. You're just going to have to guess, right? If we're going into a downturn, right? Think about this. If you're a restaurant, so you're thinking of like a DoorDash or Shack Shake, or Shake Shack, excuse me, and any other like McDonald's, things like that. If we're going into a downturn like we did in the corona pandemic, the growth rate on those type of companies are going to be a lot lower because of people are going to want to save money, so they're not going to eat out as much. So therefore, they're going to have a lower growth rates year over year. So that's just an easy way to kind of tell. You're not really going to know 100% what the growth rate is going to be. It really is all just user input. So I mean, like here, if you've never been to the Corporate Finance Institute website, I highly suggest that you do it. They have a lot of good methods on like what the growth rate should be. They use the weighted average cost of capital there, also in there, and they kind of go over it really easily, how to use it. Now, again, back to your percentage, what's the growth rate? You really don't know. Here, I think they use 4%, which is probably a good medium. 4 to 5% is what I would guess, because most of the S&P 500 companies are very mature. They're not going to have high growth rates besides some of these crazy tech companies like Snow or Palantir, or even some electric vehicle companies like Tesla and things. So things like that are what I would watch out for. So I would say for generic utility companies, go to 2 to 3%. Any main just run-of-the-mill company, pharmaceutical, healthcare, things like that, maybe 5%. Then any sort of tech, I would go for 7 or 8%. But just know every percent that you add on a discounted cash flow method, it's going to add an exponential more valuation aspect to it. That's why when they talk about the 10-year yield dipping and basically crushing, so let's go back and look at the 10-year yield on TradingView. Let me see if I can find it. 10-year yield. I actually have it in here somewhere. Give me a second. The 10-year yield is noted as basically the complete opposite or an inverse of generic. Let me find this real quick. Sorry to be a pain. So I'm going to put up on the 1 day here. So these are the 10-year yields. As you know, right at the beginning of the pandemic, what happened to the stock market? It completely crashed. Well, yields and the equity market crashed. Well, as yields stayed low longer, as they came down here and they formed this base from roughly March of 2020 all the way through October, they really didn't do anything. There was really no way essentially for them to say, okay, we're going to push the yields back up. But with yields staying so low for so long, it caused the growth rates and it caused people to take on more debt because interest rates were at the lowest they've ever been. So therefore, companies could grow faster because they can attain debt faster and not have to worry about the burdensome of high interest payments. Therefore, the equities market, such as the S&P 500, if I were to overlay these two, they'd be in direct, I won't say direct inverse relationship, but as these stay lower for longer, you're going to see equities stay pretty high. And you can see a long-term, this is a 1 week chart. I mean, it's just insane to think about, like, this is a long-term trend that we are just in a channel. So honestly, I could see rates going lower. I don't think they'll ever be negative, but I mean, they're in this channel here right now. So can you go over the significance of book value per share and stock price? Yeah, so book value of share, I'm just going to Google it for people so you can read, because I like to read. Book value per share is essentially something that is, in investing terms, basically what the stock is worth on paper. So it's basically the common equity divided by its shares outstanding. So essentially, how much does the company have, asset minus the liabilities or even the equity, and divide that by the shares outstanding. So a company with a 2 to 1, or just to say a 2 book value. So an example of it will be here. Let's go back to finance. So we're going to go to say Tesla, because everybody loves Tesla. Everybody hears about the PE ratio, things like that. Well, if you come over here to the statistics tab, there should be a book value, price to book right there. So Tesla's at $21, or excuse me, that's last year. So 28 right now. 28 price to book, meaning their book value would be, if we were to do this calculation, take the share price. So I don't know if you guys can see, there it is. So take the share price, 730, divide it by what their price to book is. So 28. So their price, yeah. So basically, a 28 price to book is extremely high. I look for, if I'm trying to invest in value, I'm looking for less than 2 or 3. 28 is absurd, and that goes back to the PE ratio as well, right? The forward PE. How much are you paying for $1 of earnings? That's how much you're paying for Tesla, which is, if you go to, say, like Coca-Cola, it's going to be a whole lot lower, because obviously there's not a lot of growth in there, and you can understand, right? Forward PE is 24 compared to 144. Best way to find younger, undervalued companies with a lot of room for growth. Honestly, IPOs are great for that. Now, you have a lot of risk in choosing IPOs and following along. The problem with that is you can be buying in essentially way above where you should be, way above what the company might be worth. Like, look at Robinhood. Shares priced at 28, 29. They opened up at 32, ran to 50-ish. After they ran to 50, what else happened? Now they're starting to come back down. Sorry, I'm turning my fan on. After they're starting to come back down, you run the risk. You can make a lot of money in IPOs, and that's a great way to find new companies, but there's a lot of risk and the volatility involved. Another great way is just to screen. You're going to have to pay a lot of money for young companies. That's just the way the market is right now. Anything with high growth, you're going to have to pay a high PE ratio on, or even a high price to book, price to sales, depending upon the type of company. So therefore, there's really no value. If you're wanting to look for tech value, it's hard to find. There's got to be some other outside forces going on. So an example here is going to be Activision, right? Activision is I love playing Call of Duty, but Activision recently, as you've seen right here, it's just taken a nosedive after some letters sent to the company about a fraternity-like behavior at the company. That is an outside force. So anything that does not revolve directly on earnings, that is an outside force. And wow, look at this cup and handle here. I think some of our members played that, but that's just interesting to see there. So a company like Activision is a tech company. I don't necessarily know their, let me see if I can get something pulled up here. Let's see, financials on the chart. I think they'll pull it up for me. It's just always interesting to see how companies like this, right? So price to book 3.89, PE is about 24. It's hard to find a tech company with a PE of 24, right? That's just very, very hard. And some are actually priced on price of sales. So let's see. Can you use the trend-based fib extension to go from the bottom to the top and then to the top to the bottom? Would that be the same as the fib retracement, or what 3 points used on true? So for fib extensions, right? For extensions, you're wanting to go from the bottom to the top. So you see this move one here. I'm going to go bottom to the top, and let me get out my extension. So bottom to the top, essentially, that's where you're going to want it to go. Now this is just a rough example. This isn't even, so this, I'm going to move it over here because this is actually the bottom of a trend. So what you'll see here actually is from the bottom of this trend here, I'm going to go from the tip of that candle wick, and I'm going to go to this candle wick here, there to there. So I'm taking from the bottom of a trend, right? We have a move down, and now we're starting to see a wave up. So I see a 1-2 count. 1, 2, 3, 4, 5. I can see a 5-way Elliott wave theory there. Essentially for the trend, if I see a nice move up and then start to get a correction, I can also pull out my retracement from the bottom to the top at the same place. Make sure it's a retracement. I change colors on it. And you want to make sure that it's going to work for you. So essentially, if it doesn't retrace back down, say, let me pull up the 30. It's going to make it a little bit easier. You see it pulls up here, comes back down to basically the 786 here, and then continues upwards and then bounces back again. That's what you want to see. But for the extensions, you go from bottom to the top. For the retracements, you go from the bottom to the top as well. It's just you have to be careful that the zero stays on top, because when you do a retracement, it's retracing downwards, and so you want the numbers going up on the way down. But on the extension, you want the numbers going up. So you see how it goes from 0 to 0.236. It goes higher on the way down, but on the extension, the numbers go higher there. Yeah, any other questions that people have? Just, I mean, in general, I'm just trying to be helpful, fill up some airtime. I was bored. Any sort of, fundamental analysis, things like that, we can definitely cover. So I'm actually, while that's happening, I'm going to change these up. So you can actually do this. TradingView allows you to change what's on here. I like to change the PE forward. The revenue per employee is also actually very cool to see. But I want to change that to, let me find it. Debt to EBITDA is nice. And then, what is that? Forward earnings yield, I'm not a big fan of. I don't really find use in it. And then total revenue. So one of the ways to find undervalued companies is going to be look for companies that the amount of revenue they have is roughly their market cap. So I think Tom found this company actually. Let me pull up the chart, right? It's a newly IPO'd on the stock market. Let me find out exactly what they do, because I honestly don't know. He just told me about them today. One of the cool things is if you can find a company that's valued great. See, the PE ratio on this company is a 4.92, and their market cap is roughly $8 billion, I think. Where'd it go? Yeah, 8.55 billion. And then they actually make about $8 billion in a year. Yeah. So roughly their revenue in 1 year equals their price right now. So that's not what I'm looking for. What am I looking for? I forgot what I was looking for. What do they do? That's right. So looks like they're drug manufacturers. So they're in the pharma industry, and for pharma, it usually goes about 4 times. I think that's what Sundog was telling me. The price to book ratio, obviously they have a lot of debt. So compared to the price to book, but then on the debt to EBITDA, it's only 0.437, which is Not bad at all. You really don't, for anything that like a debt to EBITDA ratio, you don't want over 3 to 4. It shows them highly levered. But this is a company that's a good example of like, just look for companies that have high revenue, their market cap's lower, because usually they're starting out and they just haven't made a lot of money yet. So that goes for like Robinhood, right? I'll wait for these financials to kind of pull up so I can show you from a long-term perspective, right? I'm not investing in something that has a negative $20 price book ratio. So that means I'm basically, when I buy it, the company is worth less on paper than it is when it's actually worth now. That's because Robinhood doesn't make money. The same thing with PDE. If it's a negative PE ratio, they don't make money. So if we think about Baidu as a company, like a normal China sentiment, what do you think about the company? They can grow. So Baidu is actually, in Chinese stocks in general, I've had some opinions on them. I think I told people to get out back in this dip up here, back in March and April 21, because there's a lot of regulatory pressure going on with China right now. We saw recently that President Xi has limited video games for children to 1 hour a day, I believe, or even 1 hour a weekend. I don't know specifically what it was, but it was a crazy amount. That just shows you the totalitarianism and the communism of China's regime at this moment. So stocks that are originated in China are very, very, very beaten down for good reason. They have no idea what the government will do next. I mean, they went for music, they went for internet stocks, so that's why Baidu and Baba are both beaten down. And as you can tell, the price to earnings ratio on Baidu is 8.04. I mean, so 8 times earnings, which is unreal for Baidu and even Baba. Baba is I think trading at one of its lowest PE ratios in probably 8 to 10 years. So this is a great way to find undervalued stocks, but as an investor, you take on that external risk, essentially. The external risk of, hey, China could come out today and say they're taking everything private and they're going to make everything a public institution owned by the government, and they're going to cancel, all this type of stuff and basically make the company worthless. That's a risk you take owning shares in Chinese companies. There it is, SIG. So SIG said 3 hours a week on weekends, which is just crazy in my opinion. So China, in a sense, has regulatory problems still persisting throughout their economy and their societal system. That's why I do not own Chinese stocks at this moment until I get basically an all clear from, hey, China said we're not going to touch these type of companies. Then I might be able to invest in them. But at this moment, it's untouchable for me. So even though they're at a steep discount, if you're willing to take that risk, by all means, go ahead. I just, as a personal investor, I just do not see value in there, right? I prefer to invest in mostly domestic, like 99% of my holdings are in domestic. There's a few ADRs, but in general, I stay away from Chinese, and the only other company or the only other countries I'll invest in are either Japanese or probably some Indian stocks. So what about SoFi? Seems to have good fundamental. So I actually differed with Tom and Sundog. So if you ever follow along in investing chat in our Discord, which you can find the link in the description right now, come join us. We talk a lot about this company right here. So SoFi. Let me pull up the daily chart and make it a little bit more pleasing to the eyes. SoFi is a hot topic and it's discussed quite frequently, honestly. The problem I have with SoFi is obviously it has a negative PE, so there is a lot of growth left. So it is a growth name. It currently isn't making money if you want to think about it, because the EBITDA, as you can see right there, they're losing $663,000 every quarter essentially. But they do not have any debt, which is super nice in the sense of the debt to EBITDA ratio is negative, and that's where you start to see things, right? You only need 4 or 5 good ratios or good indicators for you to kind of see the gist and the overall and the entirety of the company as itself, right? Obviously, you want to dive in, read 10K, 10Qs, read all the company filings and read company presentations, but I can see right here, okay, SoFi is an $11 billion company. Right now, it claims they have 0 revenue. I know they have revenue, I believe, because I have worked there. So let's see. I guess I don't get it with SoFi. That sucks. But over here, yeah. So revenue, right? Yeah, they have revenue. They just don't make any money still. So it's a super high growth stock if you're wanting to get into it. But the price to earnings is just, I don't really like things. The price to book isn't that bad, 2 to 3. Like I said, it's a good range. So SoFi in general, I personally won't buy it. I don't like to dive too deep into these new fintech stocks. I think they're overvalued in general. I mean, look at the unicorns and look at the private companies out there. A lot of fintech startups are the ones that are going for 15 to 20 multiples of ARR, or basically whatever the revenue is. People are paying 15 times that, when in general it's roughly around, like, the median's 8 to 10. So in my opinion, they're overvalued. But what do I know, right? As long as the Fed keeps printing money, we're all going to be rich, and the stock market will go on forever. I mean, look at SPY. It's just been unfreaking real, breaking upwards out of this rising wedge, major trend line here. It's just interesting to see a major trend break like that. Not a lot of people talk about it. Now, the volume wasn't as spectacular as some people put it out to be, but we'll see. Best time to enter a trade: in the money. I'm guessing that means out of the money, OFM, not sure, and at the money. So, okay, so that's generic trading. I mean, I guess I can go over. Since somebody asked about Disney, I'll just pull up their chart. So, let's say we're watching Disney right here on, what is this? Last Monday, I believe it was. Disney opens up, and this is a 15-minute chart. Opens up, way up, gaps up. It kind of consolidates on the 15-minute. Now, let me go back to the 5-minute, because I know a lot of people prefer to watch the 5-minute. So here is that gap up I'm talking about. Gap up, kind of consolidates back down. It starts creating a flag here. We recognize it. We hop in the trade, right? Okay, wow, bull flag. Let's hop in it. Starts consolidating. Right as it breaks above, what type of trade would you want to take? So would you rather take at the money, in the money, or out of the money? Me personally, if we're already at $176, I'm only looking to get to the top of this flag and then see it to retrace and retouch. So at this time, I would probably take at the money, because it's going to be a quick day trade for me. I mean, if you played at the money 176s or 177s here, and that went up to 177.50-ish or 177.30-ish, you're probably going to make a good 20, 25, 30% with at the money. Now, if you took out of the money, like $1 out of the money, and then rode that momentum up, you could have made 50 or 60, but if it turned against you, you'll lose a lot more of your money there. As you can see, Disney just kept going up this day, so that would have been something to buy and hold. So that type of trade, if you know you're going to be in it for a long while, I would go ahead and get either in the money or at the money, because of you don't lose the premium as quickly. So say Disney went here, then continue to retrace back here. If I grabbed out of the money calls, I'm going to be down a lot. Whereas if it retraced back down to here but still held this bull flag support level, then I wouldn't be as concerned, because I know I have at the money or in the money calls, and I'm going to retain a lot of that implied volatility, because it's not going to affect me as much. Now, with the benefit of this, it continued going up. Obviously, you don't know that when you're trading, unless it's explicitly written out in some TA somewhere. But in general, I prefer at the money, because you're not dealing with momentum. And if you buy on a candle like this, where it's spiked up right here, and you bought the out of the money, you're going to be paying way too much, 20, 30 over asking essentially, and it's going to spike back down, and then you've overpaid for an option. You're already at a loss, etc., etc., etc. Disney, I actually like Disney from a long-term perspective. I think I put that out on my Twitter a couple of days ago. It's one of the things I would probably never sell. It took a hit in Corona, but obviously you can see what's happened since then. The only thing on the chart I do not like is like an extended head and shoulders pattern here. Not saying it's going to happen, but it looks like an extended one, right? And it's got a gap to fill here, gap to fill here. So I do think Disney will come back down to the 130 area. I know I'm dreaming. People will tell me. But honestly, we're due for a correction in equities. But from a price to sales ratio, not that bad. It's 5. Price to book's not that bad at 3.7. I'd like to see the price to book come down. That's going to help when they start to repurchase some shares. Price to earnings ratio is crazy at 295. That doesn't seem right. No, I can't really trust TradingView anymore. Maybe I shouldn't be checking on TradingView. Yeah, I guess it is 295 PE. Wow. Yeah, but I mean, Tesla's at 140 now, I believe. Let's see why. They took a major loss in 2020, and that's why the trailing 12 months. So anytime you see a TTM as a trailing 12 months, so the reason this PE ratio is so high is for the past 12 months during the COVID pandemic and even into 2021, they didn't make a net profit. So, and we can look at why, but they didn't make a net profit, which means they have to take the price over their minute, small, little earnings they made this past quarter, which essentially over the past, I guess the past 12 trailing months, I believe. Here's the net income. Here it is. So it looks like last month or last quarter, Oh, I want quarterly actually. There we go. So last quarter they made only 923 million. Is this in millions or thousands? Yeah, it's in thousands. Okay, so they walked away with basically 1.4 in EBITDA and let's see, 923 in net income from continuing operations. So PE ratio is concerning, but as you can see, there's a negative $4.7 billion loss right there, 710 million, I believe, right there. So it's been fluctuating there in general. So there's a problem if you want to look at Disney that way. But I think Disney has the know-how to essentially navigate waters like this, and they have a ton of growth. I mean, it's the mouse. You don't really go against the mouse. So one way to look at these types of things, though, is just a graph, right? You can see the revenue here in 2019 spiked. They really didn't do as bad in 2020. They just must have spent a ton of money in 2020 retaining people, working from home, whatever it might have been. Most companies saved money in 2020 by having people work from home, as well as having generic other cost savings from not paying taxes in certain cities, not paying water bills, power bills, housing bills, rental bills, maintenance bills, maintenance people, etc., etc. So yeah, so somebody asked if I can talk about a correction in equities. I can. The problem with this, and that I found, is you're never going to be accurate. You're never going to time it right. And I found that to be true, actually. Sorry, I'm going to turn my lamp on. But yeah, you're never going to be true. You're never going to be right. Everyone can say they're going to predict an equity crash. I personally don't see equities correcting. I mean, obviously here soon, right? Let's see. Let's pull up the SPY chart. So on the 1 hour here, you can see there's a lot of gaps to fill on the way down. Here's some support areas. Here's a gap here. They did fill the gap there, filled the gap there, but we're still waiting for one gap to fill here. Not necessarily does it have to be filled, but most people like to see them be filled. So here on the 1 hour, I do think this gap here will be filled back down to 444. So I think I am a bear going into next week, even the end of this week, dependent upon what happens. But as Avery has stated, right, Avery I think said he's going to be a major bull in the next 48 hours, which is, or not a bull, excuse me, a major bear in the next 48 hours because of dark pool wasn't buying this run up. And that's what I stated was, if you look at the volume down here, it's just nothing spectacular. It doesn't even eclipse the 20-day, I think that's the 20, let's see. Yeah, so the 20 moving average of volume didn't even eclipse that. Yep, hang on, Sig, let's see. Sig sent me a DM real quick. He wants me to go over it. Oh, yeah. Okay. I wonder if I can actually open these up on the screen. Give me a second. Hang on, Sig. I'm doing it. 1 second. So Sig sent me some DMs of some good charts I want to go over. And let me open them up on my computer real quick so we can look at them on the top screen. Let's see. All right, so Sig sent a few charts here. Let's just open them up and get these out of the way. So one of the first ones he said here, and these are going to be some interesting charts. Now, you may not know what the heck's going on, but let's just kind of dissect them. So this first one, sucking credit risk premium out of the market. I'm going to read them out loud. Who needs protection when markets move only one way and corrections are getting smaller and smaller? The buy the dip mentality is reinforced on a daily basis. We've seen VIX move sharply lower through Jackson Hole. The CDXIG printed new post-corona lows Friday. That's interesting. So I actually deal with a lot of CDXIGs. So what that basically is just a CDS index, an investment grade index, meaning it's measuring the credit default swaps on investment grade bonds. And what that means is in the equities market, all you have is you're buying and selling a stock, and it's based on what future cash flows or however you want to do it with dividends, whatever. Well, with bonds, you have this thing called a credit default swap. And essentially, it's like a put option for an equity. It's if the borrower defaults on their loans and they default on their bond, their debt, then the person who owns that credit default swap can either sell it or reap the benefit, right? So if I buy a credit default swap down here, right, and equity prices take a dump and bond prices take a dump, and the credit default swap, essentially the rate on that credit default swap spikes higher. I bought it at 16 and I could sell it for 94. So there's a lot of money to be made, and that's actually how most of the money was made in actually in the 2008-2009 bubble. In the 2008-2009 bubble, that's actually how a lot of the money was made by Michael Burry. A lot of the people that were shorting the housing market, what they were doing was buying credit default swaps on housing companies and and even on mortgage-backed securities. They were buying credit default swaps. So it's very interesting to see that make a new low. So this one says still too many bears around. I can agree with that. AA bear sentiment was no good readings for the bears. We need bears to go back into hibernation before anything meaningful. So there's actually this reverse psychology that goes into the market where if a ton of bears are bearish on the market, it can cause a short squeeze in the market, right? So this is even before the AMC, the GME. This is actually fairly interesting. So if you look at it here, the farther the market goes up, and I don't know if I can mark this up. I don't think I can, but you can tell here when the market crashed here, bears, just everybody got bearish on it, right? All of a sudden. Well, obviously you see what the market did. Now that's not the only correlation. It's not, causation is not correlation by any means. But the more and more people that are bearish on stocks can cause the stocks to equivalently basically make a V-shaped recovery. And you see that almost everywhere. V-shape, V-shape here, V-shape, 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 V-shape. Most stock market corrections end in a V-shaped correction, or end in a V-shaped recovery, excuse me. So it's actually very interesting to see bears just now starting to pile on. I'd like to see this indicator get back down to the lows here because that's when you start to see meaningful correction. Like right before the COVID pandemic, it started to tick back down. The same thing in the 08 or the 2008 tech bubble. It started down low when the correction started, but as it went lower and lower and lower, more people got bearish, bearish, and bearish. Well, when you have that many people piled into shorts, it can cause a short squeeze if one minor key area of resistance is broken. And then hedge frustration. So the put to call ratio, this is actually fairly interesting too. This is something that SIG talks about all the time with gamma exposure, meaning if there's too many calls bought, then brokers and more mutual funds and hedge funds, etc., market makers have to buy more shares to drive the share price up to even compete with being gamma neutral on their position. So nothing new, but the theme continues. People are loading up on puts at local market lows. This keeps reinforcing the logic of hedges only cost money. So exactly. So we see these level 4s, level 5s of IWMs coming in right at the lows, and this is what I'm talking about. People start to buy puts right at the lows, which reinforces the notion that people can get squeezed out of their positions, and they're really only hedges, meaning if you think about it in the human psychology, once things start to get bad, people think, oh, it can only get worse from here. Meaning, oh, this is the end right here. Every single bear probably said, that's the end. That's the end of the market. This is the correction there, right? Every single time there's a correction. But if you've learned anything from myself, learn this. Do not fight the Fed and do not fight the trend. What is the trend in the SPX right here on the S&P 500? It's directly up. I mean, directly at a 45-degree angle upwards. Whereas maybe the Fed's also buying and you have a 45-degree angle up. I mean, just don't fight it. Now, if the S&P is continuing to go down, you can see it, right? So if we go back to TradingView, thanks for those charts, by the way, Sig. If we go back to TradingView here, and I pull up a weekly chart on the S&P 500, and I go back into actually, let me go back to the daily first. It'll be a little bit easier to see. If I go back to the 08 correction, right, look what happens here, right? The beginning of the top of the bubble, I guess you could say, was in October of 2007. It didn't actually bottom out until March of 2009. So that was a long correction. Now, granted, in today's market, there might not be that long correction that we've been waiting for, but it was in this channel, and people should not be fighting the trend here. And even then, right, you think it's going to bounce here, it's going to continue going down. It can get worse more than you think it can. So it's the same thing when you take a step back and you start to view the market in a holistic approach and see, look what the market's done. And this is a weekly chart. I mean, just don't fight the trend. And so if I drew a trend line from the middle, I could dream that S&P 500 will come back to touch this line here. And just for kicks and giggles, I would like to see how far of a drawdown that is. That's a 40% drawdown. So roughly what we saw in COVID is what we would need to see on a bigger basis, honestly. So Bitcoin tanked. Let's look at Bitcoin. Glad I didn't grab any Bitcoin. Wow. What in the world happened here? I mean, that's been happening all day. This happened at 12 p.m. That's interesting, though. So yeah, oh, what's up, Rao? Didn't even see you there. Sorry, I've been going on tangents here for a while. I don't know if there's any other questions that I can answer into. Those charts are fairly interesting that Sig had sent. Those are very interesting to kind of watch and view and see from a holistic approach. Got my coffee at, what is it? Let's see, 8 p.m. my time. Another way to find undervalued companies, whoever was asking that, if you go to this watch list tab, Yahoo Finance actually has a lot of great watch list in here. So like most active penny stocks, small cap stocks, whatever. Yeah, what's up, Sig? Go ahead. I learn from you, you learn from me. Whatever I can teach, I'm willing to teach by all means. But in here you have like worst performers recently updated. So if you don't know what type of stocks you're looking for, you can come in here and say like, okay, tech stocks that move the market, cannabis, Berkshire Hathaway, most active penny stocks, crypto bets. I mean, I'm not really one to develop targets for, say, Apple and things like that, but let's see what Sig said. All right, so Sig, Apple, will you break out? Yeah, let's see. I'm trying to copy this into TradingView, Sig, and let's see if it's going to let me. Copy, paste. There it is. I didn't even know you could do that. All right, so this is what Sig sent me. Apple's pushing close to all-time highs again. The stock's done very little since early July, but a close above recent all-time highs, and people need to chase anything good that hasn't squeezed lately. Note the gap for QQQ. Yeah, so there actually is a lagging from Apple to QQQ, and I can honestly probably say, not definitively, but with a good estimated guess, that the reason that Apple's lagged the market since July is the lack of growth. Now, you might be telling me I'm crazy, sure, but Apple doesn't have a lot of growth behind it. Now, yes, they grow, but compared to newer stocks and stocks that are e-commerce, not hard, tangible products, they cannot grow as fast with supply chain constraints, with very little and limited growth on iPhone models. I mean, that's their major moneymaker right now, is iPhones as well as Macs, right? You can only do so many upgrades each year, and people are only willing to buy a new iPhone every couple of years because if there's no drastic changes in the iPhone or the Mac, or the iMac or whatever, the laptops, then there's really no incentive to buy something new. Whereas if Shopify comes out with a brand new feature that changes and revolutionizes small business and enterprise, especially during COVID, they're going to grow at a lot higher rate. So fairly interesting to see that. He sent me another one. So the answer was, will Apple break out? I mean, I'm sure it'll break out. And technically, you could draw. I mean, you could take this as a bull flag with a false breakout here. And it's technically already broken out. It's consolidating halfway up on the flag. And it's going to continue up to 165, 170. But I don't like to speculate. Should we get ready for upside pain part 2? If we were to follow the S&P from 1995 versus now, seasonality things get even more painful to the upside. Yeah, see, I don't mind fractals, and so what I mean by fractals here, fractals are essentially taking a chart that has already played out or that has already happened, aka this 1995 yellow S&P 500. I don't mind saying that. Oh, dang it. I don't mind using them sometimes, but sometimes people take them to a literal extreme, like it has to follow it keyframe to keyframe, essentially. I mean, this is possible if, let's see, how many months is that? September, October, November. So I could see this happening by the end of the year, having the S&P 500 roughly around 5,000, 4,800 to 5,000, continuing up because if the Fed decides to essentially start tapering, right, that's not going to shock the market. The only thing that's going to cause a massive correction will probably be the shock to the market, aka coming from raising interest rates, which I don't see them doing. They've only talked about tapering asset purchase programs, which is, if you don't know, scaling back the amount of assets that they've purchased. So when we looked at those 10-year yields recently, I told you what was happening was, actually I think this is the Treasury 10-year, yeah. So this is the yield on the 10-year yield, or on the 10-year note, right? What has happened is when they purchase these treasuries, they're suppressing short-term rates. So 10 years roughly, it's longer on the scale of the interest rate. So if I were to draw an interest rate curve, you want interest rates to look like this, meaning this is, say, 3 months, and excuse my thing, this would say be 5 years this would be 7, and this would be 10, this would be 30, whatever. Not the scale, whatever. But the farther out you go, the less, I mean, obviously the more risky, right? So this normally is going to be about 3.5 maybe, all the way up here. Well, what happens is on the curve of a bond, on the curve of this interest rate or this yield curve essentially, the shorter amount of time, there's less risk in you loaning somebody money for 3 months versus 5 years, if you're correct in that, right? So the difference in these two is known as basically just the difference, the premium of a 5 year to a 3 month. You can kind of compare the two. Well, what happened when COVID hit was, if we draw another yield curve here, what happened was the yield curve inverted, meaning it basically was the 10 year and the 2 year at least. It was cheaper for people to like it looked like this, where a 3 month might have gone for 2.5 and a 10 year might have gone for 2, which meant it was cheaper to lend somebody money for 10 years than it was to lend them for 3 months, because they see higher risk in the 10 year period than they do in the 3 month period. So this is in general how bonds work, and that's the way that the market can kind of be told from the Fed point of view. But back on the Fed, right? If they're suppressing short-term interest rates and they're tapering, I don't necessarily see them shocking the market and causing an S&P 500 correction. So I could see that seasonality chart that he said was going on. I could see it happening. I think this right here, I could see it following through, but I'm not one to play around with fractals as much. Do I use trend-based fibs? No, I just chart it and see what looks good. I mean, honestly, if you were to chart, like, these are the 10 year yield notes, right? Okay, it's pretty simple to see. It doesn't have to be perfect. Everybody thinks that you have to have each individual candle touching the trend line. It's not the case. As long as you're within reason, like this right here, somebody could say, "Oh no, you need to come down here." Well, okay, that could be a false breakout. Doesn't matter. As long as it's in the channel and it's within reason, it's good, right? I could look at this and professionals would go, "Yep, that's within the channel," because it's not going to be perfect. The market isn't perfect, but as you see, we're in a downward channel. So until we break upwards out of this, I'm not going to be really bearish on bonds anytime soon, because yields are inversing bond prices. So as long as these yields continue to go down, bond prices should continue to increase. But as soon as these yields start to break back up and go towards over here back to the 1990s levels of maybe a 7% yield on a 10 year note, meaning you have to have like probably a 7 or
Hello, hello. Oh, who was on live? I saw Thomas was on live. Big. Big, what are you up to? Thomas was on live. Is Thomas still on live? Hang on 1 second, guys. One second, guys. Tom got booted. Let's see what's going on. This dude. Thomas is funny. Alright, so I am taking over for Thomas then. It'll be pretty brief. So, and I did realize that now, huh? Alright, we'll worry about that later. So, pretty much, I was just gonna give a quick recap. Everyone can hear me so far? As I took over for Thomas. I know you guys got bored of him anyway, so it's okay. Really quick recap for everyone. Pretty much looking at SPY. SPY actually broke our level that I had from last time. I am the captain now. I don't think so. Everyone can't hear me, right? Thomas, tell me you can hear me. And here goes Raul. All right, we can hear. Perfect. All right, so pretty much my overview was for SPY. I had us breaking that 452 level. Looks like we're right above that 452 level. Thomas had also shown a chart where we actually broke above that resistance level. So now our next level for this, what we would say a squeeze, is going to be that 457, 458-ish level. That's what we're looking at now. And as you see, I kind of outlined my support levels that I'll be looking at once we do hit that resistance level for SPY 457, 458. And we'll see exactly where the downfall actually lies from there. If we also see we actually created another gap that was created right around here around that 444 level, right down below near that 443 level as well. So that's a gap to watch as well once we do get a reversal. Now, kind of big picture that I wanted to give everyone was long-term resistance lines, especially at market all-time highs. And this near-end squeeze that we are was long-term resistance lines. And this is what you want to be paying attention to now that the market's this high up. Especially if you're looking at adding to long-term positions. This is not really the moment in time. And if you're looking to swing positions, this is not the moment of time either. I'll get to Zoom. I actually had a chart on Zoom that was already there, but COVID actually didn't let me look at that. Otherwise, I probably would have joined Tay, and and I would have joined also. I believe Dan had a position in Zoom as well for earnings, but it is what it is. Here's one of the resistance levels for Apple that I'm looking at. This is on the 4 hour. So pretty much looking at your resistance points from September 2020 up until January of this year. And then now we're approaching that level right around that 154 mark. So we'll see exactly how Apple actually reacts to that 154 mark once it hits that resistance. Are we actually going to break above it for some reason? Which we actually saw. We saw Netflix actually break out of a wedge. We saw Tesla break out of a wedge. The other thing with Apple is that they actually have their event coming up within, I think, 2 or 3 weeks here for their iPhone release. So that's something to keep in mind. But that 154 mark is definitely something to keep an eye on, big picture wise. Tesla, pretty much like I mentioned, I know that I had Tesla put spreads. I was actually expecting to reject that 723-ish area. It just didn't happen that way. And I actually got out late because I completely forgot about it. It is what it is. We'll bounce back on the small account. But as you see now, we already broke above that resistance level. We're now heading towards that 749, 750 level, in which we'll see what Tesla does once it gets there. All right, so 750 is pretty much, it looks like it's heading towards that direction, unless for whatever reason market actually decides to act a little bit horrible, in which we know that Tesla can actually chop with data. And that's where if you're having out of the money calls right now, that's where you want to be a little skeptic. So don't try to hold too long, especially if Tesla goes chopping. Facebook, this is also one to keep an eye on with that long-term resistance, which I actually think it just hit that long-term resistance. If we actually take a look, we hit multiple resistance points. And now we actually just hit that straight on today with that $8 move that it made today. If you notice exactly where it hit. So we're right there on that resistance point. So that's something to keep an eye on, how that's going to react going into tomorrow. Actually, coming to think about one that actually hit a resistance point was Nvidia. Nvidia was one of the actual newsletter plays. Let me just remove the lines and I'll show you exactly how that played out. All right, so let's pull that out and stretch it out. So now, as you see, we actually hit a resistance point in February. We hit another resistance point in July. And now we just came and we hit another one here at the end of August here. So the other factor is to notice is the actual drop-offs from once it actually hit that resistance point, which is first it was a $38 drop, then a $30 drop. So it would pretty much signify that it may be another 30-point drop. I wouldn't say 30 plus because it could somewhere fall in between those ranges, but that is a possibility. I wouldn't rule it out. So that was actually what we saw today. It actually hit that 230 mark. And guess what? It actually gave back most of its gains because now it only closed the day up 52 cents. So that's definitely how you would keep an eye on that. If you actually bought puts at that 230 mark when it actually hit that resistance point, you actually would have profited knowing that bigger picture, it hit that resistance point and it rejected. But if you didn't look at the bigger time frame, you wouldn't have realized that, right? Because we usually get caught up looking at weeklies, looking at 5 minute to 15-minute time frames. We don't typically look at the 4 hour and daily charts. Let's see what other one that I was looking at. I think Microsoft was another name, and then I'll get to Zoom real quick. So here's also Microsoft. If we now stretch it out, we can get a good image. Now we see we hit a peak in February of 2020. We hit another peak here, September 2020, and now we just hit that peak here in August. But now we actually see we had that falling wedge. It's now pushing again. Could it actually retest that resistance zone? It's possible to get to that 307 level. I wouldn't doubt that. But then at that point in time, that would be where you want to be skeptic about that, holding a call position. And like I said, you don't want to be swinging calls in this kind of environment. You're actually looking for trouble. Because what basically happens is that you're pretty much with a plane right now with no landing gear. You're at high altitude, but once we do crash and when we crash, which you won't know, then it's going to be hard to get out of those kind of positions, especially make it out break even, right? And real quick, and yeah, this is why I said I was a little bit upset about Zoom. I had a double top formation. It actually broke that, it broke right down on the actual support zones, right here around that 331 level during that earnings. And I had my last support level at 302, which we're pretty much at after hours. So that was one I was like, damn, I could have been in there. With Tay and Dan, it just didn't happen. I wasn't even looking at it at all. But it is what it is. Other than that, I think that's pretty much the macro of the larger time frames for most of these big tech names. That's why I wanted to make sure I give everyone a bigger image. Because there's not really much to micro as far as, we're right at the end tail of the squeeze, the market squeeze, where, we could see more pushes. I think Netflix was one where I actually skipped over, just like how Tesla is. It broke the wedge, which is another support line down here, but it broke the wedge. It actually broke out, it retested, and as we see now, it's actually pushing higher. Now, I wouldn't doubt that it's actually going to push higher. maybe we see it right around this level of that 370 to 371-ish area. But then, up at that point, are we gonna really push towards all-time highs? I don't think we're gonna have enough juice in the market to really push us that high, but we'll see exactly what happens to that extent. When do we get into Zoom? I don't know if I really want to get into Zoom, to be honest with you. I really don't like that. Let me see if I turn on extended if I can see. Damn, that is a fat kill candle. That is really a fat kill candle. Sorry for my dog, by the way. Let's see. Ew. Let's see where we can settle down at. Is there another support level? Yeah, it would have to probably rest on my support right here. 301.88-ish. Let's see if I get in. 302.10. 302.33. Let's see what this one lines up at. 301.89 and 302.54. So 301, 302 we need to hold in order for us to get a bounce. That's where I would tell most of you to get in calls if that be the case. If you are really itching to get in there. 270s. This guy said wait for 270. I wouldn't doubt it. Um, I think the downtrend is going to continue. If you want to say 270s, yes, the downturn is going to continue. Now, this is going to be an intermediate bounce. It's going to be a short-lived bounce to that extent, if you want to say so. So yeah, if 301, 302 holds, that'll be an intermediate bounce. But then there will be further downside where that 270 level, it could come into play. I can see that definitely happening because we're gonna see a follow through on how massive that candle is. That's insanely massive. Me personally, I wouldn't want to actually get into that. BBIG, my take. I know I saw Thomas actually talking about BBIG. Yeah, I actually got out. I could have held, but since I know I wasn't monitoring my positions and I kind of needed to get some rest today. Um, hmm, let me see what I look at. Let's see what I could take a look at here. I saw that Thomas actually called. This is actually a double bottom formation right here. If you actually see it, which is a really good sign. So kind of feels like we actually are going to be looking at upside. Let me actually change the color of that so you get a better image. Looks like a double bottom formation. So we're likely going to get a nice little push to the upside here. In which case you get that double bottom, kind of like how Zoom was, the inverse of Zoom. This is pretty much the opposite of that formation wise, where you're going to get this double bottom formation. And from that standpoint, then we're going to see where that leads to. I know with the short interest, with the volume, that's where that's going to be a different story. If we end up breaking back above that high, that's when things get a little bit more different. For right now, I do think that getting over that 7.95, $8 range, that's where things will get actually, you know, a little bit more interesting when we actually see the volume starting to come in. Right. So that's pretty much my take on BBIG. I think Thomas was on the same page about the $8 mark. So it's right around that same area where it's gonna actually overtake that intermediate resistance level. And then we'll see how the volume and the short squeeze actually propels it higher. Spot, I haven't looked at Spot in quite a while. Spot has been dead. Actually, wow, it's not that dead as of recent. Hmm. Let me see if I get a bigger time frame. I haven't looked at this stock in quite a while. That is really a falling wedge of some sort. It's not an inverse head and shoulders because even though you have a left shoulder here, you have a head, the right shoulder is too steep. So it is pretty much a downtrend that has not broken. See if I can actually get better image here. I'm not really liking that at all. You could say that it's just breaking that downtrend. Not something I particularly like. It feels like a weak move. Mm, Nothing here that's really appealing to me. If I had to say a resistance level, it will be right around this 250 level. I'll draw the line. I'll actually show you exactly why. Let me get the my resistance zone here. Right around here, right into here. So as we see, that was pretty much a support level right there. It actually acted as a resistance right here. And then it was just shy of acting as a resistance right here. So as we see it kind of breaking this downtrend, it could end up making that push towards that 250. But then once it gets to that 250 level, I would have to see how it acts there because I would expect it to reject, especially how the market's running on fumes right now. Once those fumes actually exhaust itself, spot will actually follow through with that to some extent as well. Root, I think Thomas was looking at Root, if I'm not mistaken. Which, if he's in this chat, he could probably agree to that. But I was pretty sure he was. I don't know if he's actually still holding Root. I gotta ask him that. Definitely need to ask him that. Wow, that shot up to 854 and all the way back down. Yeah, that's not very something much I would want to be a part of. It gave back a little too much, and I don't see anything that's showing any sign of reversal that is giving me any indication about that. Yeah, I don't show any sign of reversal here. That's where kind of looks a little bit flat out to me. Nothing looks really appealing. Could be you want to see a falling wedge. That might be a falling wedge right there, but it would need to get back over the 670 level to see any kind of meaningful reversal, if you want to say. That's 669. Yeah, 670 is that level where you want to see it actually break above if it's able to get out of this falling wedge. And then we'll see if there's any meaningful reversal en route. But as of right now, nothing is a confirmation here that shows me this is going to break out of the falling wedge and get any kind of reversal there. All right. Other than that, I think that wraps up tonight, guys. So hopefully you guys at least got a bigger picture on the big mega cap tech names on the resistance levels. So you have a good idea, as far as market approaching new high after new high, where are those long-term resistance lines and knowing that, all right? Other than that, I think that wraps up tonight's session. I'll be back tomorrow and hopefully we have some more great charts to look at, all right? You guys have a good